Hello everyone, thanks for checking out my video. US stock market had its worst weekly performance for the year. It was a rough week with three major indices drop more than 2% in the shortened trading week. The market pullback had continued likely because inflation remains sticky and stubborn. With 3 consecutive weeks of losses, 2023's uptrend is under increasing pressure. Will the market find its footing this week, or is it going to continue to fall? Let's discuss them in this video. Investors' enthusiasm waned further last week after a string of reports showed that the US is seeing a stickier than expected inflation and a resilient economy. The Federal Reserve's so-called preferred measurement of inflation, aka Personal Consumption Expenditures Price Index, came in stronger than expected. Basically, January's PCE price index overshot economy's expectations as it rose 4.7% from the previous year, ahead of forecasts of 4.4%. This is a sign that inflation is sticky, and this could translate to longer and higher interest rate hikes by the Fed. In fact, the FOMC meeting minutes that were released last week has indicated that the Fed isn't planning to stop hiking rates anytime soon. As a result of all this, US stocks fell sharply last Friday, wrapping up their worst week of 2023. To add on, major indices are either breaking or testing key support levels now. More on this later in the technical analysis segment. Okay, so what to look out for in the week ahead? No crystal ball here, but currently the stock market is recalibrating based on the latest economic reports. And so I would think this adjustment will likely continue in the near term. Market will probably continue to digest the hot inflation data. Day by day, it's getting more and more evident that inflation is not falling at the pace and extent investors have been hoping for. Therefore, investors and traders need to start recognizing that January's market rally belongs to the past already, and we should adjust to the current reality, which is major indices and stocks are trending lower. But does this mean we will start to waterfall down to create a new market low? Not quite so yet. Again, this will be further elaborated in the technical section. On a side note, there is a huge event coming up this week on 1st March, and that is none other than Tesla's Investor Day. During the event, Tesla may reveal a next generation lower cost Model EV. Other topics that could be covered are Model 3 refresh, battery storage expansion plans, self-driving hardware including better chips, more cameras, and a new radar. What really excites investors is the potential coverage of Elon Musk's Master Plan 3. Okay, now let's cover the technical analysis portion. SPY is looking bearish at the moment as it closed below its 50 moving average last Friday. If the market continues to be weak, we can expect SPY to retest the 200 moving average at around 390. This is a very critical support area. I repeat, it's a super important level. Why so? This is because there are 3 support levels here. The first one is of course the 200 moving average. The second one is the downtrend line. And the third one is the 38.2 Fibonacci retracement level. And if this triple support level gets breached, I think things can turn really ugly. SPY may just take the escalator down to sub 380s. To add on, can you see this green dotted line? SPY was on this uptrend since it hit its 52-week low of 346 in October. So from October last year to February this year, this trend line has been intact, and that was a good 5 months of uptrend. And so this trend line has been breached last Friday. Seems like SPY wants to make a round trip back to the red downtrend line. Anyway, to reverse this bearish trend, bulls need to reclaim the green trend line as well as the 50 moving average as soon as possible, and print at least 2 green candles above them with good volume. Anyway, both of these levels will now pose as a resistance, followed by 401. When that happens, then we could possibly go towards 418 again. At this point, it does seem like an uphill task. Meanwhile, I am just wondering, who knows, maybe the market is pricing in all the hot inflation talks and a potential 50 basis point rate hike now. And maybe, just maybe, we could rally during the next FOMC meeting if the rate hike turns out to be lesser. Anyway, this is just my pure wild guess with nothing to substantiate with. So take it with a huge tablespoon of salt. Alright, let's move over to Apple. Apple's potential bull flag is almost invalidated now. Since we hit the high of the flagpole, Apple has printed 14 candlesticks and is still unable to break out of this bull flag. Personally, I think if it does not break out of the bull flag within 12 to 15 candles, the bull flag is kind of invalidated. At this point, Apple is sitting at a dangerous spot, which is the 200 moving average at 146.7. Last Friday, it actually closed the gap that I have highlighted in my last video. So this gap-filled area and the 200 moving average will now act as a support. Meaning to say the next few trading days will be crucial as we will see if Apple can hold this level. If it can hold, then bulls would target the 23.6 Fibonacci retracement level with an eye set on the gap at 153. On the downside, once the 200 moving average gets breached, I think we could easily head towards 140 or even lower. A quick recap. Remember last week I shared that the MACD was very extended, and during the last 3 times when this happened, Apple went down by quite a fair bit. And then on Moomoo platform, I have also posted a reminder on the MACD bearish cross, and that we could hit towards 146.8. Look at where we are now, 146.7. Thus far, this bearish thesis seems to be panning out, and I honestly do feel there is still room for downside. And mind you, typically when Apple falls, it will drag the broader market along with it. Let us now check out the most volatile mega cap stock, Tesla. Last week, Tesla ended a 6-week winning streak as it tumbled more than 5%. Bulls actually failed to bring it up to test the 200 moving average. So if let's say last week's weakness was just a temporary pause, then bulls will want to see Tesla at least charge towards the 200 moving average at 221 this week, which will now act as a resistance. If that breaks, and then Tesla could fly towards the 230s range. On the downside, I have actually posted on Moomoo to share about the bearish MACD cross. At this point, it does appear that we still have room to go on the downside. So keep an eye on 185 as I think that is quite an important support level. In fact, Tesla has been trading sideways and floating above this level for almost the entire February. Therefore, if 185 gets breached, it could potentially open a floodgate, and we are talking about sliding to the gap at around 146 to 154 before finding a good support. Interestingly, that area is also where the 50 moving average sits at 155. To add on, the Ichimoku cloud will also come in as a support, thus forming a triple support. So if this 150 range break, good luck to the bulls. Anyway, gentle reminder to mark your calendar for Tesla's Investor Day on 1st March. It could be a potential catalyst for some huge movement. Don't ask me which direction, I wouldn't know, and I wish I could know. Now let's hop over to Google. Interesting chart here. Google actually sliced through the various support levels like a tofu since it hit a recent high of 108. So along the way, it cut through 105, 100 which is a major support, and finally 90. The last support level we have right now is around 86 to 87. If we want to be a little more lenient, then we can also see the recent low of 83 as another support level. And I would like to caution that if this 83 breaks, it will open the floodgate on the downside. Well, in the upcoming week, it will not surprise me if Google trade around this range of 85 to 87. This would be the better zone to see if the bulls or the bears will prevail. So let's say the worst case scenario happens and Google decides to take the slide down. The two gaps at 82 to 83 and 79 to 70 would be the best target. On the other hand, if bulls can step in to buy and hold this 85 to 87 zone, we could potentially form a triple bottom and get a nice bounce from there. In fact, if bears and sellers continue to step in this week and bring Google down from the current 89 level to 85, it will not surprise or alarm me. That will then bring RSI to the oversold zone and could potentially set up for a nice technical rebound. Again, nothing is guaranteed. Let's watch how it moves. Alright, now let's move on to the option trading section. Last week, I shared my rationale of selling Tesla and Google's cash-secured put contracts. Hence, a quick update on these trades is that Tesla is in a small profit zone. On this, I thought to share something with the viewers who are interested in options. For this particular trade, I sold the put contract when Tesla was at 210, and this is a slight bullish move. So last week, Tesla fell from 210 to around 197. And guess what? This slight bullish trade is profiting instead of losing, and that's the beauty of selling put options. So basically, the reason why this trade is in the profit when Tesla is down has got to do with time decay and implied volatility. I sold the put contract when Tesla IV was super high, and people were paying high premiums to purchase those put contracts. With that, I took the opportunity to sell put contract to one of these people. So when the IV dropped, and as time goes by, the value of the put contract dropped as well. The message here is, by selling put option, it doesn't mean you are very bullish about the stock, or you are of the view that the stock will fly higher. It can also mean that the stock can be a little weak and fall a little, or just trade sideways. Okay, next, not gonna run away from this Google trade. I can be honest with you that it is in the red now, but am I worried? Not really. Why so? Let me explain. In option trading, it is normal to see your trade swing from negative 100% to positive 50% and vice versa. At this point, my trade still has more than 20 days to expiration and Google still have time to recover. But even if it doesn't, I can either roll this option or accept assignment of 100 shares since I already have cash on standby and I do not mind holding Google's shares. From there, I will start selling covered calls to continue to reap more premiums. So basically, I have different options to deal with my option. There is therefore no need for me to panic or incur unnecessary loss. Anyway, speaking of volatility and swings, it brings me to this particular trade that expired last Friday. It is a covered call contract that I sold in January. As you can see that the strike price is 103 and at one point Google shot up to 108 and my trade was down 200%. Sorry I didn't manage to capture a screenshot for that. Then as of last Friday the contract expired worthless and that means it's 100% profit. So as you can see from negative 200% to positive 100% that's 300% swing. Therefore, I would urge viewers who are not able to take risks and volatility to skip option tradings, or at least prep yourself well enough before dabbling into it. With the current stock market clouded by bearish sentiment, I thought I should share something with the viewers. That is, don't get too excited when stocks gap up and make big upside move on earnings or other good news specific to the companies. In times like this, when the broader market is weak and trending lower, such gains often don't hold. Let me quote you an example. Nvidia gapped up on earnings and bullish outlook, but very quickly it faded the next day. In fact, I saw this as an opportunity to sell my position in my smaller brokerage account, where I bought it at 195 and sold at 231 to lock in about 18.5% profit. And then we have Meta that popped massively after its earnings, and so far it has been trending downwards. In my previous technical segment, I have shared that there is a possibility for Meta to fill the gap all the way to 150's range. Currently, half of the gap has been filled, and mind you, from the recent high of 197 to 150's range, that's a 40-point potential downside. Anyway, just a few weeks ago, inflation looked to be coming down at a good pace while the economy remained strong and resilient. And we had Fed adding icing to the cake by claiming that disinflationary has begun. Talks about potential Fed pivots started to float around. But how things have changed. Right now, January's various inflation reports and indicators, as well as revisions to the previous month's inflation numbers are showing that inflation remains hot and sticky. In fact, it's like re-accelerating. In short, inflation is still high, job market is still tight, and the Fed still has work to do. To rub salt to the wound, some economists believe that inflation cannot come down without a broader economic downturn. Basically, something would have to give. Could be the broader economy or the job market. And so there you go again, all the talks about recession will start to surface once more. In my view, until we have several months of reports showing disinflation across both goods and services, inflation will remain the top of mind, together with Fed's aggressive rate hikes campaign. This spells bad news for the stock market. Technical-wise, if 2023's rally wants to regain momentum, the S&P 500 has to reclaim its 50 moving average, while Nasdaq needs to close back above the 200 moving average. This would be the minimum first step to regain the bullish momentum. Anything less than this, bears are increasingly gaining their control. And to be really frank with you, this latest multi-week market pullback no longer looks like just a normal small pause in an ongoing market rally. Major indices are sitting at a dangerous zone now. Though it does not mean that we will be in for a new market low, investors and traders should probably buckle up in the next 1 to 2 months as we will be in for a choppy ride. Alright, that's all for this video. What's your current plan as the market pulls back? Would love to hear from you in the comment section below. Do help me tap the like and subscribe buttons if you have not. Thank you.